For over 3 centuries, one institution has quietly shaped the fate of nations, decided the cost of money, and influenced every boom and bust in the British Empire: the Bank of England. Most people think of it as just another central bank, a bureaucratic institution managing interest rates and printing currency. But behind its ornate walls lies a story of secrecy, manipulation, and power that reaches deep into the fabric of global finance. This isn't just a story about a bank, it's the story of how money itself became a tool of control. The Bank of England was born out of crisis. In 1694, England was broke. The country had been fighting costly wars with France, and the royal treasury was empty. Traditional lenders refused to extend more credit, fearing the crown might default. This arrangement marked a turning point in economic history. For the first time, money was created not through the accumulation of gold or silver, but through debt. Every note issued by the bank was a claim on future government tax revenue. In essence, the state had mortgaged its future to fund its wars. The financiers behind the bank gained something even more valuable: a monopoly on the creation of credit. Over time, this power would allow them to shape interest rates, influence markets, and decide who could access capital. Most people don't realize it, but this was the moment when the modern financial system was born. Before 1694, governments could only spend what they had. After 1694, they could spend what they promised. The Bank of England became the middleman, turning national debt into a tradable asset. The system allowed England to outspend its rivals, fueling empire building, colonial expansion, and industrialization. But it also created a new kind of dependence, one where economic growth was tied to ever-growing debt. As the 18th century unfolded, the bank's influence deepened. It became the lender of last resort, the institution to which private banks turned in times of panic. But this role came with a price. In exchange for its support, the bank gained oversight over the entire financial system. It could expand or contract credit at will, effectively deciding when the economy would boom and when it would bust. The public was told this was a mechanism of stability. In reality, it was a lever of control. The Napoleonic Wars offered another glimpse into the bank's power. Facing enormous military expenses, the British government demanded ever more loans. In 1797, gold reserves ran dangerously low, forcing the bank to suspend gold payments. This temporary suspension lasted over 2 decades, meaning the bank was printing paper money with no backing. Prices soared, inflation surged, and ordinary people watched their savings evaporate. Yet the wars continued, financed not by production but by promises. When peace returned, so did the gold standard. But the lesson was clear. The bank could bend the rules of money whenever national interest or its own required it. By the mid-19th century, Britain had become the financial capital of the world, and the Bank of England sat at the center of this web. Its policies determined the value of the pound, the flow of global trade, and even the fate of colonies thousands of miles away. When the bank raised interest rates, credit dried up across the empire. When it lowered them, speculative bubbles formed in London and abroad. The bank's decisions rippled outward, shaping the fortunes of merchants, governments, and entire nations. And yet, for all this power, it remained shrouded in secrecy. Its board was unelected, its minutes unpublished, and its motives opaque. The public rarely questioned this arrangement because prosperity masked the imbalance. The Industrial Revolution brought jobs and wealth, and Britain's dominance seemed unshakable. But beneath the surface, cracks were forming. The reliance on credit made the economy fragile, and every few decades a financial panic would sweep through: 1825, 1847, 1866, each one revealing how dependent the system had become on a single institution's judgment. Each time, the bank would step in, providing liquidity, rescuing banks, and reaffirming its role as the ultimate backstop. People began to see it as a stabilizer, but the irony was that many of these crises had been triggered by its own policies. By the late 19th century, economists began to call the bank the governor of the British economy. Its governor, an unelected financier, wielded more practical power than most elected officials. He could raise or lower interest rates, tighten or loosen credit, and in doing so, decide whether millions thrived or suffered. This concentration of power wasn't an accident. It was the inevitable outcome of a system where money creation had been privatized and debt institutionalized. The monarchy had lost political control centuries earlier, but financial control now rested in even fewer hands. As the Victorian age gave way to the 20th century, the bank's role evolved once again. The rise of global finance and foreign competition forced Britain to defend its currency's value. Maintaining the gold standard became a point of national pride, even when it came at the expense of jobs, wages, and growth. Time and again, the bank prioritized sound money over human welfare, raising rates to protect gold reserves and triggering recessions at home. It claimed to be serving the greater good, but in practice, it was serving the creditor class, those whose wealth depended on a strong pound and low inflation. The ordinary citizen rarely understood these dynamics. To them, the Bank of England was a symbol of stability, a pillar of British tradition. Yet behind closed doors, its governors debated how to manage crises they themselves had helped create. The irony is that the Bank España's greatest strength, its independence from politics, was also its greatest danger. Without accountability, it could act in ways that benefited the few at the expense of the many. And for 300 years, it did just that. By the early 20th century, the Bank of England had become the quiet architect of global finance. Its influence stretched far beyond London, reaching into the colonial economies that powered Britain's empire. India, Africa, the Caribbean, all were tied to the pound, all subject to the invisible hand of British monetary policy. Through the imperial banking network, the Bank of England exported not just credit, but control. Every rail built, every mine financed, every port expanded, all ran on money that flowed through its system. And yet, for all its reach, the bank remained elusive, its true mechanisms hidden from the public it ultimately governed. World War I exposed both the power and the limits of this system. When the war broke out in 1914, panic swept the markets. Banks faced runs, gold drained from vaults, and the financial system teetered on the edge of collapse. The Bank of England responded swiftly, suspending gold payments once again, printing paper money to fund the war effort, and coordinating with private banks to maintain credit. In effect, the bank became the government's financier, transforming the nation's war into a debt-fueled enterprise. By the war's end, Britain owed more money than ever before, and its gold reserves were nearly gone. The empire had been saved, but at an immense financial cost. When peace came, the bank faced an impossible dilemma. Should Britain return to the gold standard and restore the pound's pre-war value? Or should it accept devaluation and adapt to the new reality? The governor of the bank, Montague Norman, a man of immense influence in few words, made his choice. In 1925, under his guidance, Britain rejoined the gold standard at the old exchange rate, overvaluing the pound and undercutting British exports. The result was disastrous. Factories closed, unemployment soared, and deflation gripped the economy. Norman insisted it was necessary to maintain confidence in the currency. But for millions of workers, it felt like confidence had been purchased at their expense. Norman's tenure would become one of the most controversial in the bank's history. He believed central banking should be an art practiced by a select few, men who understood money as mysteries. He shunned publicity, avoided parliament, and communicated in riddles. Yet behind this aloofness lay an extraordinary degree of cooperation and collusion with other central banks. Norman forged a close relationship with Benjamin Strong, head of the Federal Reserve Bank of New York. Together, they coordinated monetary policy across the Atlantic, adjusting interest rates and gold flows in ways that would shape global markets. For the first time, the world's financial centers were acting in concert, but always behind closed doors. This transatlantic alliance helped stabilize the 1920s boom, but also laid the groundwork for the Great Depression. When the U.S. raised interest rates in 1928, capital flowed out of Europe, draining reserves and tightening credit. The Bank of England, bound by the gold standard, had little room to maneuver. As deflation deepened, economies cracked. By 1931, Britain was forced to abandon gold once again, admitting that its monetary orthodoxy had failed. Norman's grand experiment collapsed, and with it, the illusion that central bankers could fine-tune the global economy. Yet even in failure, the Bank of England emerged stronger, now seen as indispensable, the only institution capable of managing crisis. The Second World War brought a new transformation. This time, the bank didn't just fund the conflict, it orchestrated it financially. Working hand in hand with the Treasury, it created vast amounts of money to buy war bonds and stabilize the economy. The old distinction between fiscal and monetary policy blurred. The government spent, and the bank ensured the money was there. When victory came, Britain was once again buried in debt. But now, a new world order was taking shape, one in which the Bank of England would have to share its influence with emerging powers like the United States. In 1944, at Bretton Woods, the world's leading nations met to design a post-war monetary system. The Bank of England sent its representatives, but it was clear the balance of power had shifted. The US dollar, not the pound, would become the world's reserve currency. Yet the bank retained a crucial role as the guardian of sterling and the overseer of Britain's new managed economy. In 1946, it was formally nationalized, brought under state ownership. On paper, this meant accountability. In practice, little changed. The same officials ran it, the same secrecy prevailed, and the same priorities guided its hand. Through the 1950s and 60s, the bank navigated the challenges of Reconstruction, inflation, and decolonization. As Britain's empire faded, its financial empire persisted, through the City of London, offshore banking, and the Eurodollar market. The Bank of England quietly nurtured these developments, recognizing that if Britain could no longer rule by force, it could still rule through finance. London became a hub for global capital, a place where money could move freely beyond the reach of national regulators. The bank didn't just tolerate the system, it encouraged it, understanding that control over credit flows was a subtler and more enduring form of power. But as the world economy globalized, the bank's old tools grew less effective. Fixed exchange rates broke down, inflation surged, and new financial products emerged that even seasoned central bankers struggled to understand. By the 1970s, the Bank of England was no longer the unchallenged master of money it once was. It had to contend with the rise of market forces, speculative capital, and political interference. Yet even as its influence seemed to wane, its role remained central. When crises struck, from the secondary banking crash of 1973 to the global turmoil of the 1980s, the bank was always there, stepping in, bailing out, and reminding the world that, in the end, monetary control was its birthright. Through it all, one principle endured. The bank served as both the creator and the guardian of debt. Its policies determined who could borrow, at what cost, and under what terms. Whether funding wars, managing empires, or stabilizing markets, it acted as the hidden engine of British power, and for 300 years, it has operated under a single, unspoken truth. Those who control money control everything. Entering the late 20th and early 21st centuries, the Bank of England faced an unprecedented era of globalization, technological disruption, and financial innovation. The rise of electronic trading, derivatives, and complex securities transformed how money moved. Yet the Bank AS core mission remained the same: maintain control over monetary stability while quietly shaping the economy. Its decisions on interest rates, quantitative easing, and inflation targets rippled far beyond Britain, influencing global investment, trade flows, and even political outcomes. In this environment, the bank's secrecy was not just tradition, it was a strategic advantage. In 1997, the bank gained operational independence from the government, giving it formal control over monetary policy, including setting interest rates without direct political interference. Critics argued this created an unaccountable institution wielding enormous power over everyday life. Homeowners, savers, businesses, and borrowers all depended on its choices. Yet, for the bank, this independence was a tool to maintain credibility, a way to assure markets that decisions were driven by financial logic, not electoral pressure. And history shows that credibility in money is more potent than armies. Trust allows nations to borrow, spend, and grow in ways that force alone cannot achieve. The 2008 financial crisis offered a stark demonstration of the bank's enduring influence. While the crisis originated in the United States, its shockwaves hit London hard. Banks teetered, credit froze, and panic swept markets. The Bank of England stepped in decisively, providing liquidity, coordinating bailouts, and later introducing quantitative easing, essentially creating money to buy government bonds. Ordinary citizens were often unaware of these actions, yet they shaped their mortgages, pensions, and employment prospects. The bank became the silent architect of recovery, reinforcing its position as the ultimate arbiter of financial fate. The lesson was unmistakable. Control over money is control over society itself. The bank's influence extends beyond economic calculations. Through regulatory authority and its role in overseeing the financial system, it indirectly affects political decisions. Governments must consider monetary reactions when proposing fiscal policies. Tax cuts, spending programs, and social initiatives are filtered through the lens of how the bank might respond. Even global diplomacy is subtly shaped by monetary policy, as currency valuations and interest rate decisions affect trade balances and geopolitical leverage. In many ways, the bank functions as an invisible hand, guiding not just the economy, but policy, diplomacy, and the daily lives of millions. This control is magnified through networks of private finance. The bank coordinates with commercial banks, investment firms, and international institutions to manage credit flows and stabilize markets. Decisions about liquidity, lending, and bond issuance ripple throughout the financial system in ways invisible to the public eye. Wealth accumulation, asset bubbles, and economic crises are all influenced by these mechanisms. Individuals may believe markets operate independently, but the bank's guidance, whether explicit or implicit, is often the invisible force directing outcomes. Its power is subtle, pervasive, and enduring. Public perception of the bank is carefully managed. Though its role is critical, the institution maintains an aura of technocratic neutrality. Speeches are measured, reports carefully worded, and meetings largely private. This creates the impression of impartiality while preserving a monopoly on monetary decision-making. Ordinary citizens see policy announcements and interest rate adjustments, but the broader strategies, negotiations, and interventions remain concealed. The bank's effectiveness relies on this balance between transparency and secrecy. Too much visibility would risk political backlash. Too little would undermine market confidence. The bank's 300-year history reveals patterns that repeat across time. Crises prompt intervention, wars fuel debt expansion, and technological and financial innovations shift the parameters of control. Yet one constant remains. The institution sits at the nexus of power, shaping the economy to serve stability, growth, and inevitably those with access to capital. It has survived political upheavals, wars, decolonization, financial crashes, and social change. Its endurance is not accidental. It is the product of design, adaptation, and an unyielding grip on the most important resource of all, money itself. Looking forward, the bank faces new challenges: cryptocurrencies, decentralized finance, climate change, and global economic shifts. Each threatens traditional tools of monetary control, yet the institution is adapting. Digital currencies, innovative policy mechanisms, and new regulatory frameworks are emerging. The bank continues to influence credit, interest rates, and economic expectations, proving that even in an age of disruption, those who control money retain unmatched authority. The lesson for individuals and nations alike is clear. Understanding this power is essential to navigating the modern economy. The story of the Bank of England is not just a history lesson. It is a window into the mechanics of power and control. It demonstrates that wealth and influence are not only about accumulation, but about the systems that create, manage, and distribute money. From its birth in 1694 to its global influence today, the bank has quietly dictated the terms of economic life. It has shaped wars, fueled empires, controlled markets, and influenced political decisions, often without the public even realizing it. Its secrecy and discretion are part of its strength, yet they also highlight a profound truth. In modern society, money is power, and those who manage it wield influence far beyond what most citizens comprehend. By examining the bank's history, patterns emerge that are instructive for anyone trying to understand finance today. Debt creation, central control, regulatory authority, and strategic secrecy are not relics. They are the tools through which money continues to shape society. Awareness of these mechanisms is essential. Citizens who understand how monetary policy works and who controls it can make more informed decisions about investment, savings, and political engagement. The bank's story is a reminder that financial literacy is not optional. It is necessary to understand the forces that govern the economy and ultimately everyday life. For 3 centuries, the Bank of England has proven its resilience and adaptability. It survived wars, revolutions, financial crises, and the evolution of global capitalism. Its strategies have shifted, but its central mission remains: control the creation and flow of money, manage economic stability, and maintain influence over financial and political systems. Ordinary citizens may never see the inner workings of this institution, but its impact is felt in every transaction, every policy decision, and every economic cycle. Understanding its history equips us with the knowledge to navigate the present and anticipate the future. The Bank of England is not merely a bank, it is a blueprint for the exercise of economic power. Its history teaches that those who control monetary policy can influence societies on a massive scale. It shows that financial authority is inseparable